Good afternoon, everyone. I'm Samantha Brennan, Director of Business Development here at KLG, and I'm excited to be your moderator for today's webinar. Thanks so much for joining us for part one of our three-part series, Valuing a Closely Held Business. Today's session, Documents Requested and Interviews of Parties, is all about setting the stage. Gathering the right documents and information is critical to a strong valuation, and we'll walk you through how to get started the right way. A quick look ahead. Part two, where we'll dive into income approach, valuation adjustments, and double dipping, is coming up on June 24th. Part three, covering the market approach, cost approach, and discounts, will follow later this summer. If you find today helpful, and we're sure that you will, we hope you stick around for the full series. Just a few housekeeping items before we dive in. Today's session is being recorded. If you have any questions, please feel free to drop them in the Q&A box at any time. After today, you'll get a follow-up email with the recording and a link to sign up for part two. And now to the speakers. Why isn't it moving?
Just hit the
yeah, got it. Okay, so thrilled to introduce today's speakers. Our first, Jeffrey Gibraltar. He's a partner here at KLG with deep experience in business valuation, forensic accounting, and expert testimony. Presenting today with Jeff is Joseph Ammirati, our managing director, who brings a wide range of expertise in valuations, forensic analyses, and litigation support. Together, they're going to walk you through what to ask for and what to ask when you're starting a business valuation. Quick disclaimer before we begin, today's presentation isn't legal, accounting, valuation, or tax advice and shouldn't be taken as such. These examples are just for illustration, and the materials can't be distributed without KLG's express permission. With that, Joe and Jeff, I will hand it over to you guys.
All right, great. Thank you, Samantha. So good afternoon, everyone, and thank you for joining us. We had over 70 people registered for today's webinar, so really excited to see that this is a topic of interest. Based on your feedback from previous webinars, we had several requests to do a webinar that walks you through the complete process of a business valuation. So we created this series, which we're calling Valuing a Closely Held Business. As Samantha said, this is part one of the series. Today, we're going to be discussing documents requested in client interviews. And then part two is going to discuss the income approach, valuation adjustments, and double dipping. And that one is scheduled for, I believe it's June 24th.
Yes, that's correct.
And then part three is going to discuss the market approach, cost approach, and discounts. And that one's going to be scheduled probably towards the end of the summer. So the idea is that each of these webinars will kind of build on each other, and walk you through the entire valuation process and the methodologies we consider. So also, if you happen to miss one of the webinars, it's going to be posted on our website, so you'll be able to view it there at your leisure. So we have a lot to cover. We want to be mindful of everyone's time today. So if you have questions along the way, please enter them in the Q&A section at the bottom of the screen. If we're not able to address the questions during the presentation or at the end of the presentation, we'll make sure to reach out to you individually to respond. But please, we encourage lots of questions. It just makes this more, more interesting. So the topics which we will cover today, why is a business valuation needed and the scope of evaluation engagement. So as attorneys, you're often the ones that are going to be retaining the valuation expert. So it's important that the valuation aligns, with specifically what your client's needs are. Joe is going to talk about the initial information needed to get a retainer agreement together. Then I'll talk about the preliminary documents that we request and why they're so important. And then finally, Joe is going to discuss the interviewing of clients, both the titled spouse and the non-titled spouse for a matrimonial matter, or the partners or whatever that are involved in the case. So first, what is a business valuation? So a business valuation is a formal process to determine the economic value of a business or ownership interest in a business. And valuations can either be informal, where we prepare like a calculation of value for discussion purposes only, or they could be more formal, where we're preparing, a formal written valuation report. So a lot of times we'll get asked, can you prepare something, a back of the envelope calculation or something that's going to give us an idea of value? And the answer is yes, but certainly for litigation purposes, a more formal valuation report is going to be needed. So let's talk about the most common legal situations where a business valuation is needed. So certainly in divorce and family law matters, if a business is part of the marital estate, the court needs to know the value of that asset for equitable distribution purposes. For estate and gift tax planning purposes, so when a business owner transfers interest either during life or at death, the IRS is going to require a qualified business appraisal. So business valuations are also going to be needed for estate and gift tax planning purposes to support planning techniques like if a grad is being prepared, if a family limited partnership, or if they're going to be using minority interest gifting strategies. For shareholder partnership dispute purposes, so in a shareholder dispute or breach of fiduciary duty claims, a business valuation is going to provide the foundation for determining damages or fair buyout terms. For mergers, acquisitions, and exits, so if clients are selling, buying, or merging businesses, a business valuation is going to help establish a foundation for a price and possibly a starting point to begin negotiating terms. For business succession and buy-sell agreements, so for many business owners, they may have agreements that state, if a partner dies, if they become disabled, or if they retire, what the business is going to be sold for, or what that person's interest is going to be bought back at. So if the agreements are going to specify specific terms, then a business valuation is needed to calculate the value based on the provisions of the agreement. And if the agreement does not specify specific terms, then evaluation is going to be needed to determine the value. And then lastly, for economic damages and commercial litigation. So for lost profit claims or breach of contract or business interruption cases, evaluation expert, is going to be needed to calculate the damages. So at KLG, we have significant experience in preparing valuations for all of these purposes. And if you have any questions about whether a business valuation is needed, you can always reach out to one of the partners to discuss. So what should you as attorneys look for in engaging a business valuation expert? So first, you want to make sure to engage the right expert as early in the process as possible. So the more time we have to plan, the better. A business valuation is not necessarily a quick process. We first need to obtain the documents needed, which we're going to talk about in a few minutes. But even once we receive the documents, it could take several weeks to complete the assignment. So typically, we estimate it takes about 3 to 6 weeks from the time we receive all the documents needed to complete evaluation. Second, you're going to want to make sure that that person is qualified with relevant credentials. You're going to want to make sure that they have credentials such as an ABV, which stands for Accredited in Business Valuation, a CVA, which stands for Certified Valuation Analyst, or an ASA, which is Accredited Senior Appraiser. And even more important than the alphabet soup of letters is this an area that they really truly specialize in? So many accounting firms will say they prepare business valuations, but maybe they do few of them a year. So you want to make sure that the firm truly specializes in this, and that this is the work that they do day in and day out. And then you want to make sure that the person has a proven track record of expert witness experience and testimony experience. So, we always say that picking which case is going to go to trial is kind of like, the lottery balls of numbers. So we never know which case is going to go to trial and is going to require testimony. So you want to make sure that the expert you pick has ample testimony experience. All right, and so now I will turn it over to Joe to discuss the scope of retention.
Thank you, Jeff, and good afternoon, everyone. So once you now establish you need to have a business valuation, we are most often contacted either by the client themselves that's looking for the valuation, if it was for estate, gift tax planning, or one of their representatives from the state or their tax attorney. And for matrimonial purposes, more often than not, we're always contacted by the attorneys themselves, or we'll receive a court order asking us to, perform a valuation. But there is some key components we need initially to, we'll call the initial inquest. First and foremost, of course, the name of the business that we'll be valuing. Um, then second, the interest that we're valuing. Are we valuing 100% interest, control interest, or are we doing a fractional minority interest on a non-marketable basis? So these are questions we'll ask as well. What is the interest that we're valuing? Most important, of course, is the valuation date. A lot of times, again, for the matrimonial purposes, we'll get a court order. Sometimes that information is there, sometimes it's absent, but it's usually one of our follow-up questions thereafter. Are we doing this as of a particular date, whether it's date of commencement or multiple dates, about date of marriage versus date of commencement, or current date? If estates is usually the date of death, or for gifting, the date of the gifts. So again, that becomes a very important question as well. Following that with, well, what is the purpose of the valuation? Are we doing this for a litigation purpose? Are we doing this for a non-litigation purpose, tax purpose, shareholder dispute? This is all going to be information that we're going to put forth in our engagement letter. There's the contracted services where we're going to lay out specifically what we're being requested to do, the tasks we're going to perform. And again, who is engaging us on this contract? Is it the attorneys? If it were neutral, it's going to be both parties. If it's one side, maybe we're doing it through the counsel as their expert. For estate purposes, is it the executor? So again, we want to at least know at the end of the day who is hiring us to perform the valuation. We're also going to want to identify, who the client is. So if it's attorneys that are contacting us, what's the name of the parties involved? Who are the individuals? What's their contact information? So at least again, we want to just try to build up as much information as we can to put this contract together, so everyone's on the same page as to what it is we're doing or what we're being engaged for.
And
One thing
just
we're
to,
also going to,
if I
sorry.
could just jump in, Joe, just, to add to that, we want to be really specific. So to the extent that it's a limited scope engagement, if we're asked to do an analysis, but we're not going to do any forensic analysis, or if we're asked to just do a calculation of value, these are the things that we want to make sure, we understand and that are specifically outlined in the engagement letter. So everyone's on the same page in terms of specifically what we're going to do and not do.
Correct. One also aspect was, typically the standard of value we want to disclose in our engagement letter. We will be doing the valuation either on the fair market value standard, which is common for most matrimonial actions in New York, or are we going to be doing something different, whether it's like a shareholders dispute. That's more state specific and state defined. So usually it's fair value. So we would look to them to what that means. So for those who don't know, fair value and fair market value is willing buyer, willing seller. It referenced in Revenue Rule in 5960. It's the standard of value, trying to make both parties equal and knowledgeable of the relevant facts and circumstances. Fair value, is pretty much almost the same, just that there's maybe not often a consideration for discounts, and this is more common in shareholder disputes. It's basically the orderly transaction between the market participants as of a date, but again, state defined. Sometimes it could be for other type standard of values, whether it's investment value or that's value to a particular person, or intrinsic value, which could be the true or real worth of an item if it's for securities. Again, those may be for specific purpose type valuations we're doing it for. But again, that's why we always ask, what's the purpose of the valuation? So then we can match the appropriate standard of value. And again, have that be disclosed in our engagement letter. So again, everyone knows what we're presenting at the end of the day. Another a question we might ask is, well, what is the deliverable? What kind of valuation report do we need to issue? Is the client requesting a full detailed report, which will have all the bells and whistles and be very comprehensive? It's almost like a standalone document that the parties can then, explain the industry background, the very detailed analysis of the business, the finances, the methodologies used, how the calculations would perform, the information provided. But maybe something less in scope is needed. So sometimes we want that disclosed. Maybe they just want a summary report that doesn't need to have all of these, try to curb fees, or the participants don't need that level of detail. There's also calculation reports that could be a little bit more, again, specific, that only have a specific task. Again, this is all, and for us to put together our engagement letter. But also in that will be our fee structure. Sometimes these engagements could either be a flat fee assignment or it's billed hourly, and then we would request a retainer amount in that. So we're going to ask, this is the amount we're going to be charging as initial retainer, but the fees are based on our professional rates, hourly rates. So that will all be disclosed in our engagement letter as well, and who's responsible for fees. So if it's a matrimonial, is one party 100%, is it 50-50, 60-40? So we want at least all that laid out in the agreement. And of course, the signers of the report will be disclosed as the partner who's going to be performing the task and the staff. So that really concludes the initial information we're going to request. But like I said, we're going to segue now into more of the documents and information we need. Because once we prepare our engagement letter, we'll then subsequently or attach to that letter our full document of request, or it's our preliminary information that we need to start now the engagement and perform evaluation. So I'll turn that back over to Jeff.
All right, yeah. So just like Joe said, we're now engaged on the matter. It's laid out in our retainer agreement specifically what our scope is. And now we're going to issue, or along with the retainer agreement, we're also going to issue a preliminary document request. So for many of you that we've worked with, you've seen our preliminary document request before. So today I'll just highlight some of the key documents required for a business valuation, and really more importantly, why they matter. Why are these documents important? So first, tax returns. Typically, we are going to request for a 3 to 5 year period. And the reason why we're going to request for this period is because in valuation language, that kind of represents an economic cycle, right? So we want to see how the company has trended over those years. So we're going to ask for the corporate tax returns, 1120s for if it's a C Corp, 1120S for an S Corp, 1065 for partnerships, and a Schedule C for sole proprietorships. And the tax returns are kind of going to be, they're going to be key. It's going to be our starting point to identify the revenue and the expenses that are reported by the company, to begin to identify any potential red flags or inconsistencies in the reported numbers, and also to validate, owners' compensation and distributions that are taken, at least, for a pass-through entity. And unlike internal financial statements, tax returns are filed under penalty of perjury. So while we know that people do lie on their tax returns, and I'm sure that's no surprise to anyone, but we're going to, accept these tax returns with a grain of salt, and, they do carry some weight of credibility, at least on the surface. Next, we're going to ask for financial statements. Again, we're going to request this for, a 3 to 5 year period of time. We're going to request income statements, balance sheets, statement of cash flows. If the company has audited or reviewed financial statements from a CPA, we're going to request those as well, because they come with some level of assurance from the accounting firm, that they were reviewed or audited, and and that they were looked at a little deeper than if it was just an internally prepared statement. And similar to the tax returns, the financial statements are going to give us insight into the revenue and expenses reported by the company, cost structure and margins, the assets and liabilities of the company, and working capital, and what the operating versus the non-operating income looks like. Next, business plans, budgets, forecasts. So oftentimes, a small company may not have these types of documents, but if they do, it gives us insight into the company's expected trajectory going forward, which could be really useful if we're using like a discounted cash flow methodology to value the company. And this is going to be discussed in more detail. This specific methodology will be discussed in more detail in the next webinar series. But if a company has projections, it's going to be really important for us to understand, were they prepared before or after the litigation began? So obviously we want to make sure that these aren't going to be, self-serving, especially in a litigation situation, and that they're consistent with the historical performance of the company. So we want to make sure that there's a track record of some sort, that the company has hit these projections in the past, and that they're not just, significantly different than what they're continuing to project. Next, accounting records. So this is going to be a really important area, but general ledgers, trial balances of the company. If the company uses an accounting system like QuickBooks, which we find many small or even large companies do use QuickBooks. So we're going to request in those situations, we're going to request a backup copy of the accounting system so that we could generate our own reports electronically, to make review even more efficient. I'd also lump into this category bank statements and credit card statements. So the general ledger, just to kind of explain in detail what each of these are, the general ledger is the detailed record of all accounting entries, kind of line by line. It's like the checkbook of the company. The trial balance is just going to summarize the balances for each of the accounts. Bank statements, are obvious in terms of the information that they're going to show, but it's going to give us information about the deposits and the withdrawals from the bank accounts. And the credit cards are going to show details of spending. And sometimes if they use a QuickBooks system, the detail of the credit cards may already be downloaded into QuickBooks. So this is going to be ideal in terms of, us reviewing that detail. So all of this documentation, what are we requesting it for? We're really requesting it for purposes of doing our forensic analysis. So we're going to want to, track down if there's any unusual expenses or personal expenses that are being paid through the business. We're going to want to verify the consistency of the books and records with the tax returns or the financial statements. We're going to want to identify if there's any related party transactions or phantom payroll that's, that's within the books and records. So basically, all of these types of documents are what we're going to use to make our adjustments or our normalization adjustments, what we call it, to earnings. And at the end of the day, in order for us to value the business, what we're trying to identify is what is the true income of the business to the owners. And based on that is how we're going to derive value. Let's see, next, ownership agreements. So these are going to include operating agreements, shareholder agreements, partnership agreements, buy-sell agreements. And these are going to be critical for understanding, the ownership percentages, who owns what, if there's different classes of stock, if there's restricted stock, unrestricted, or, different voting shares versus non-voting shares. If there's any specific rights or restrictions, who has control over the business to make decisions, like selling the business or taking additional loans out of the business. Are there valuation methodologies or triggers specified in the agreement? So, for example, some agreements may require the use of book value or fair value rather than fair market value. Or there may be provisions in the agreement that state that the value is going to be without consideration of discounts. So we're going to want to, consider all of those terms. Next, organizational documents, such as articles of incorporation, bylaws, meeting minutes, stock registers, if there's capitalization tables, any other type of official documentation like this. And these are going to tell us, one, what type of an entity it is, whether it's an LLC, an S Corp, a C Corp. Obviously, we're going to see that from the tax return as well, but it's going to give us the entity type. It'll tell us the ownership breakdown and voting rights potentially, what the number of authorized shares are versus shares that actually are issued, and if there's any amendments or structural changes that are important. Next, payroll records and owner compensation. So we're going to request W-2s, 1099s, payroll summaries, details of any benefits or perks that may be paid to owners or executives. And these documents are going to tell us who is being paid a salary from the business. So we can see if there's any family members, that might be on payroll that might not be working for the business. And we could also see the level of salaries that are being paid. And this is important for when we're determining reasonable compensation, who are the highest paid employees within the business, and how much are they making. Next, customer and revenue data. So we're going to look to see top customer lists, sales by product or service, whether there's any recurring contracts or subscriptions, if they have sales pipelines or backlogs. And all these documents are going to be important to determine customer concentration, whether there's a higher or lower risk that would affect the multiples we use for valuation, and if there's any contractual relationships, which might indicate more stability of future earnings. And again, this is all going to affect the multiples that we use for valuation purposes. If there are any industry-specific documents or market reports that the client is aware of or has access to, we'd want to see those. So, these reports might discuss what's going on in the industry, such as industry growth rates, market rates, valuation multiples, et cetera. So typically, we're going to look to sources that we have, databases that we have, such as IBISWorld or PitchBook, to obtain this information. But if the client has access to something that's more industry specific than we do, it's going to be helpful when using, the market approach and developing multiples. Legal documents, we're going to request information about ongoing or threatened litigation, if there's any regulatory compliance issues, any licensing agreements, if there's leases or, or real estate contracts. And these again are going to all be important for determining, risk when we're determining, the valuation. Debt agreements and loan covenants. So we're going to request loan documents, lines of credit, or if there's restrictive covenants. So for example, if a company is restricted from paying dividends for some reason, or if there are capital expenditure limits, we're going to want to understand that. And lastly, I'll just mention it, we don't see this as much, it's not as common, but if there's any intellectual property or intangibles that are owned, we're going to want to see the intellectual, the trademarks, the patents, the copyrights, or if there's any proprietary technology or software that they own. And this is going to really be most applicable for, for service-based or technology companies, where the intangible assets may be the primary source of value. So we're going to want to verify who the owner is, when it expires, the renewal terms, and whether these are transferable. So these are the main documents really that we're going to look to obtain. And so all this is going to be outlined in our preliminary document requests. And then once we go through the interview process, which Joe is going to talk about next, there may be additional documents, follow-up documents that are going to come out of the interview, that we may supplement and ask for after the interview process. So Joe, why don't you go walk us through the interview process?
So, of course, in valuing these closely held companies, in a perfect world, we'd get all these documents information, but that's usually not always the case. Sometimes things don't exist. The businesses aren't as sophisticated, but our document request at least is providing guidance saying, hey, this is, we want all this information. But if those certain informations don't exist, then maybe we can gather the relevant information through client interviews. So when performing our evaluations, it's very important to conduct these interviews to gather the necessary information to arrive ultimately at our opinion of value. So besides reviewing financial records and legal documents, there's a lot of non-financial information that we also like to consider. And we gather this information through the client interviews. So again, who's typically should be interviewed? Well, obviously, in a matrimonial purpose, we're going to want to interview the business owner to get the information we need from them. If we're neutrals in the cases, we'll speak to the properties and non-property spouses, just to hear both sides, so we can help navigate our discovery and our information that we might need. Also, to get a flavor of what are the other key issues in the cases that the documents might not reflect. If we're doing things for, sometimes these business owners, if they have a fractional interest, we'll see if we can then interview maybe the next key management person, the president, the CFO. We're also going to want to speak to the controllers because they'll provide the financial information and background necessary for us.
Can I just add,
Sure.
generally we say we don't care who's involved in the interviews. It's up to counsel. If we're neutral in a case, if everyone's in agreement for both parties and, and counsel to be on the interview, that's fine as long as everyone's in agreement. Sometimes the interviews are more, they're a little more open, I guess, if counsel's not involved. So a lot of times, I'd say more times than not, probably we do interviews without counsel present. And I think it just tends to make everyone a little less, you know, stressed during the interview and maybe tend to, you know, to be a little more open to talking. So, you know, just keep that in mind. But at the end of the day, I mean, we don't care who's involved as long as everyone's in agreement.
And of course, depending upon the business that we're valuing, sometimes the interviews should be conducted at the site, so we can get a flavor of the operations. But oftentimes, you know, if that's not as necessary, we can at least to get the process started. We'll do these interviews via Zoom or virtual calls just to help, again, move the process along. If site visits aren't, you know, as important, if a value like a large law firm interest, you know, we don't need to visit the law firm. We've seen what offices look like. So again, specific to the assignment, you know, we can conduct the interviews either on site or, you know, virtual. So, you know, the rest of this presentation, I just want to cover some of the major key areas we, you know, want to get information on that's important to us. And these will cover operational and financial issues. So if we go back to the first slide, Sammy, I'm sorry, go back. Okay. You know, obviously if you've seen our reports, we kind of lay out almost our, you know, Q&A with respect to the same layout. So when we get to the business description of the business, we want to at least know the history and background. So we'll ask the owners, again, who formed the business, when it was formed. Again, that could be relevant now if it's for matrimonials, for separate property, you know, arguments or valuations as of two dates, or for shareholder disputes, who really started the company, and you know when was it formed, but what also is what's the business activity, you know, are we valuing a law firm interest, restaurant? So we want to understand that the industry is involved in. Now we'll be able to garner a lot of this information from the documents provided, but like if anything, sometimes we like to keep the more human element and gathered information, you know, through a Q&A process is always better than sometimes just read a document as a standalone, so we can provide more insight. We'll also look, you know, ask questions about the organization structure. I mean, is it a sole proprietorship? Is it a partnership, as Jeff touched about? You know, we can again know that from the tax return filings. But again, we lay this information out in our report. As the reader, you don't know this yet, what we looked at or identifying. We're trying to make it as simplified as possible. So when you read our reports and you get to the history and background section, it should lay out exactly. By the end of the paragraph, you should know, you know, again, when it was formed, who formed it, what the business is, what industry it's in, what tax structure it's under, the ownership structure. But we'll
And
also
again,
want to look at.
just before you get into the ownership structure, we're going to do the interview, you know, unless we have a retainer agreement that's telling us specifically, you know, that it's a limited scope engagement. We're going to go through the full interview process because we don't know whether at the end of the day, if we're going to need to write a report, if we're going to need to testify. So, you know, we're going to go through the interview process, not only to understand, but also for purposes of writing that, you know, that formal report. So we don't have to go back later on and conduct an interview if we're later asked to do a formal report.
And going back to like documents, sometimes an interview, it fleshes out other entities that we might not have been aware of. So if there's a main entity, you told us to value ABC company, but in the documents maybe don't disclose it, but through interviews we find out there's subsidiaries and affiliates all involved. You know, this is our opportunity now to get that information so we can go back and say, I know our retainer agreement said this, but in our interview it's been uncovered that there's real estate holding entities and investment holding companies and there's affiliate loans. So do we need to expand our scope at that point? So this is again gives us that opportunity to gather that information. Again, we'll talk to about the management structure. You know, if there's multiple members, the roles and responsibilities of each of the shareholders, whether they're participating members or silent partners or shareholders. If there's different classes of stock, you know, and what did each of those different of classes of stock mean with respect to voting, non-voting control. Again, a lot of these smaller companies might not have sophisticated operating agreements, shareholder agreements, but you know, sometimes there's reality where we'll ask the business owners, okay, well, what does it mean? What does Joe's 10% interest get him? Can he withdraw at any time he wants? If there's no agreement, we'll try to figure out, oh, what have they been doing historically? You know, what is their understanding of, you know, what that interest means or how much control they have and decision making. So we'll try to gather, you know, get the client's representations at that point. We'll also ask about maybe there was equity transactions. Did anyone sell their interest, buy their interest? Again, this is going to be important for us as we value the business to see if these are proxies of value or if these transactions were at arm's length or represent, market rates. We'll also want to, in our Q&A, understand compensation structures, as Jeff mentioned. We can have the W-2s, but at the end of the day, well, how are they paid? What they're paid? Is it commission based? Is it salary based? Is there, who determines the compensation structure? If I'm valuing the controlling interest, do they effectuate, I guess, all the salary, for each of the other shareholders, or is that now a negotiated standpoint? So these are just some of the questions we'll ask. We go to the next slide. And then that would segue to then employees. So, again, we can have a list of W-2s and we can see salaries being expensed on the tax returns. But now in this interview process, we can ask, well, are there key employees? Is there employment contracts, non-competes? This is all going to be relevant for us when we're doing a risk profile. So part of our valuation is assessing the risk of the business. So these interviews allow us to start gauging that. Is this a business with a lot of risks, no risks? If it has key employees that are under employment contracts, that's a good thing. They lock them in, so for a certain amount of period, or they have non-competes. They can't just leave and take proprietary information with them or a contact list. That could be a risk factor. We'll want to understand the number of employees. Sometimes this is important for, cash businesses. They can have, 5 people on the books, but when we do a site visit, we see 20 people in the kitchen. One of those type things. So we'll ask those questions. What's the real numbers there? What versus, reality versus what is representative versus what's being presented on, documents. Again, as we touched upon, salary and commission of employees. If there are key employees and they're being paid, commissions, is there a top salesperson in there that if you lost them, how detrimental to the business would it be? So these, again, questions we'll ask about. And if there's any incentive compensation plans or deferred compensation plans that we should be aware of. One thing we'll also cover is, with the business is the products and services it sells. What does it do? Is there top products or services that make up a large percentage? Can we get the breakout of that percentage of revenue? So this goes to, like I said, the additional documents we might request, because as we're doing this interview and we're uncovering, okay, wow, there's 10 key products, but 2 products represent, X, or there's a customer concentration where one customer represents 15%, 20% of sales. Now let's start getting, sales reports so we can quantify the information that's being told to us through documents. So then we can present it in our report as factual, and then we're basing our valuations on that. We'll also talk about certain trends in the markets with the clients. They're the industry experts. It's their business. We can do all our research, but we want to match it to what, what the business owners feel the trends in the market are. Are they going towards obsolescence? Is there products or services in demand? Are they geographically, locked to like Long Island versus being maybe a multinational type business, which again, with sales, we want to see is there long-term contracts versus short-term contracts. So again, as we look on a tax return, it might have our information of revenue, but this is now our deeper dive into that information. And this is what the interview starts fleshing out for us. And we'll ask, again, who are their target customers? What marketing efforts is the business doing? Is the business going in a state of, growth, or is it flat? So we're looking for that as well. Okay, so go to the next slide. Again, just looking at the operations of the business, we want to understand the assets that it owns. So we get on a tax return, it might show, cash and accounts receivable and fixed assets and equipment, but we don't know, again, is there major equipment? If this is an excavating type company that has, $1 million of, excavators and front loaders, believe it or not, sometimes it can be more value to that than the operations because these things don't depreciate as much. So it's important for us as valuation analysts to do besides what could be represented on the tax returns, which in a fixed asset schedule that might just have the line item equipment listed for 300,000. Now this is our opportunity to say, okay, what is that 300,000, to get that information, so then we can find out if there is any significant major equipment or if they do an accelerated depreciation. Same thing with the business facility. Do they own the facility they operate out of, or is it leased? If it is leased, what's the length of the lease that remains? Like, for example, like in a restaurant valuation, that becomes one of the key issues because the longer the lease, the less risky, the more potential value versus if it had 1 year left and a landlord wants to now increase rents. But we'll get that information in the interview. Also, if there's future needs, for the business, does it need to obtain new equipment? Does it need to do a rehabilitation of their operations? That's going to affect value in the future or cash flow in the future. So we'll ask those questions as well. Also, competition. What's is it major competitors? Are you niche to the market where you have the biggest market share? What is the company's size relative to its competitors? Again, locations, are their competitors, local versus, or is it, multinational, big public companies, or is it online based? So this gives at least, when we approach these interviews, I always try to do a little bit of a kid gloves approach where we're just trying to get the business owner. I'll walk in and say, just educate me as much as you can about, so I can walk away knowing everything I need to know about this business from the operation standpoint, because I have to now convey the same information in a report to the readers, whether it be, the IRS, the courts, the judges, the attorneys. So at the end of the day, I can properly explain what your business is, what it does, what are the key components, what are the risks involved, what are the good, bad, and ugly, basically, so that we can then utilize that information. The reader knows that we know it to present our values. Thereafter, once we get an understanding of the operations, we'll do a deeper dive now, maybe into the financial questions. So these, if you want to go to the next slide, Sam. Okay. So once we have our information, the tax returns, financials, usually we start building our valuation models from that. But this is where we can now ask specific financial questions. So oftentimes, if we're speaking to the business owner, they might say, you know what, I'm going to defer you to my CFO or accountant to handle these questions. But we at least still try to get their input as well as to, again, what are the trends that are going on from what we're seeing? Typically we look at the past 5 years and we want to understand, okay, we see that from the tax returns, the business is growing. Why is it growing? Especially since COVID happened, we're seeing now the before and after those trends. Did it rebound? And we'll ask the specific questions as, was there a certain, something that happened in the market that caused a spike and then now it's back to reality, or is the growth sustainable, or the declines, is that temporary or permanent? We'll also ask, again, if these, financial statements that were provided, if they're, there's different levels, usually audited, reviewed, and compiled. So if they're audited, we know sometimes a lot of the information we're going to ask is going to be disclosed within those financials. But if it's on a compiled, where most small businesses are, or tax returns, this is where we have to do our own accounting Q&A just to see the numbers behind the numbers, I guess, understand the trends. And this is where, again, we'll speak to, whether it's their internal accounting department or CFOs. Also, what we're going to ask about is, besides, if there's key vendors, is, with expenses and certain trends, is there recurring income items and expenses or non-recurring income item and expenses, perquisites being paid through the company. A lot of times, sometimes they'll disclose it to us, or they'll say, no, nothing's there. And then we have to do our own forensics with respect to those, adjustments, because these become part of our financial adjustments. So the interview helps guide us in that area as well. And this is also going to be relevant for attorneys, whether it's through depositions or, cross-examination is the same type, theories and questions come to mind. Now, is there, personal expenses? Is there credit cards? How many credit cards are being paid? Does the spouse have a credit card? Do the kids have a credit card? What about personal autos? I'll ask these questions,
You'd be
even cash.
surprised.
Yeah,
You'd be surprised what people will
it's
admit
almost
to.
like wearing an IRS hat, but a sense of, we're going to ask the tough questions. And I tell them this is an invasive process if it's a matrimonial litigation, but I have to ask these questions and I'm going to be blunt with them. Is there cash? Is there, perquisites? And if things don't make sense from our observations, we explain why we keep on doing this, not just to make their lives miserable, but there is a purpose. Attorneys are looking for us to get these information so then they can, either help move their case along, settle, try it. But that's our purpose, is to gather as much information as we can. But we're also going to ask about, other financial things like, capital expenditure needs. Do they need to keep, besides the profits they have every year, maybe they can't take every dollar out. They need to keep a certain reserve to buy future, equipment, or they need working capital that cash flow comes in every, quarter, not daily, or there's long receivable collections. So, well, and that's going to even segue to some of our other questions. If they have, you know, accounts receivable? Is it long standing? Is it collectible? We'll ask for age reports on payables and receivables just to see those trends. Does the company pay distributions to its members? So if we're looking at again, who's controlling the financials? So going back to our question, if we're valuing the controlling shareholder, but he has got other partners, um, and everyone's receiving distributions. Who's determining that? Is that a mutual effect? Because if I'm valuing one of the minority interests, that's going to become an issue in the case where someone says, "Listen, I get $100,000 a year distribution. I don't have that decision, but yet the business can have like 5 million in cash sitting there." But we need to ask that question, and we'd only get that through an interview. We're also going to ask about. You can go to the next slide, Sammy. Other non-financial information is, has the company ever been audited by the IRS as sales tax? Again, we might not have asked that on our initial doc request. Most often we do. We'll say if there's any audits, but again, as a subsequent, interview process, they might tell us, hey, by the way, I had a sales tax audit 3 years ago and everything came out fine, or I had these adjustments, or I had an IRS audit. So that's, we can help flesh out as well. And then we'll ask subsequent, make a subsequent document request. Same thing with certain loans. We'll see them on the books of the company, but now we want to at least understand, besides giving us a loan document, but why did you take the loan? What was the purpose of the loan? Was it for equipment? Was it for working capital? Is there payments going to be made? This was big with the SBA loans. I'm trying to understand that, people were getting them for COVID, but was it for a real business purpose, or did you take that and buy a boat now after with it? So again, the interview all helps, flesh those type issues out. Um, Another type of questions we might ask, Stan, you go to the next one. At the end of the day, what are the positive attributes or the negative attributes of the company? What are its competitive advantages? So when we're speaking to someone, if I'm valuing, widget maker number one, why are they number one? What separates them? So again, when I'm doing or we're doing a risk profile of this company to value it, these factors that become either why we're either calling it more valuable than not, or less valuable from these factors that we gained from the interviews. We'll ask also, maybe if there was any offers to buy, has anyone approached them? With private equity now becoming a big issue, market player buying up certain companies, whether it's HVAC, plumbers, accounting firms, it's changing the market up a lot. So we will ask those questions. Has anyone approached you? What kind of offers have you bought, or has any member wanted to be bought out of their company? You don't have an agreement, but what's the process with that? But also, even though we're bound to a valuation date, subsequent events sometimes could play, a key part. Maybe there was a big loss of a client, and we'll give the client the opportunity to explain that. I mean, more often than not, people want to tell us more, the bad stuff than good stuff, when we do an evaluation, especially in matrimonials. So, we always hear, "Oh, I lost a client, I've lost this, business is going down," but we'll ask about that. When did it occur? When did you know about this is going to happen? So we can at least, understand the timing of that subsequent event and how relevant it might be to the valuation date.
And I don't know if you made this point earlier, but I just want to mention if it's a matrimonial matter, we'll typically interview the non-titled spouse first, just to understand what their concerns are before we meet with the titled spouse. This way we could address those questions, head on, and like Joe said, ask the difficult questions and see how they respond. And it's, you never know what you're going to get from an interview. Like I remember I was working on a valuation of a medical practice, and I'm looking through the books and records, and there was like University of Delaware, and it was obvious, what this was for, his child's college education or whatever. And I said to the doctor, I said, "So what's this expense, that was buried under," I don't remember what the category was, but what's this expense for University of Delaware? And he looks at me and he goes, "You're good." And I'm like, no, I'm not good. It's right here in your general ledger. It says University of Delaware, but you'll be amazed at the type of information that you'll find in the books and records. And then when you ask the question, a lot of times you'll get an honest answer, and that'll be helpful for us doing our adjustments and our valuation.
Yeah, like even in our doc request, because of my 30 years of doing this, it maybe only happened once where, we'll ask the question, is there a second set of books? We don't put that on our doc request.
Right.
And someone says, yeah, how many years back you want? And we got the information. So again, the clients sometimes are willing to, give us the information, but without asking the question. And like important what Jeff said, if speaking with maybe a matrimonial non-property first, we understand it's a sensitive topic, but I'll always ask the client too, listen, you're bringing up a lot of issues, and I do want to bring this up now to the other party. Are you okay with that? Because sometimes, clients might not be very adversarial or concerned about the blowback. So, one thing, if they do bring up very sensitive type topics, or he's got, whether it's cash or, you know, fraud that might be happening, I always let them know, listen, if you bring it up, are you comfortable with me now asking that question? Because, and sometimes, most often, it usually says yes, because that's why I'm bringing it up. But, if you're, I don't want the attorneys getting upset saying, well, you brought that issue, and now that there's a landmine in the case, and now my client's concern that was brought up. I don't know the issues, but, we know this is a very sensitive, especially with matrimonials, you know, in gaining information, how to ask it properly without, but we do have to be blunt.
Yeah, that's a good point. So Sammy, any questions? If anyone has any questions, we encourage you to submit it in the chat.
Yes, we do have
So
a few.
sure.
What do you do when you can't get the documents and information you requested?
Yeah, so I mean, we're limited in the sense that we don't have the ability to subpoena records. So we'll make the request. If it's a litigation matter, then we're gonna rely on counsel, to make the proper inquiries and then subpoena the records if necessary. But we don't have subpoena powers. So and that's why we always encourage, that an attorney be engaged. So if we get a call from a litigant that says, "Oh, I'm, contemplating divorce, or I'm contemplating a partnership dispute or something," we'll usually say, "Well, are you represented by counsel?" And if you're not, and they still are interested in hiring us, we'll lay out, the restrictions that we're going to have. We're going to send a document request out, but we don't have the ability to force, the production of information. So we're going to rely on counsel to assist us with that.
And we have another. Is there anything you do differently if the valuation is for Connecticut rather than a New York divorce? And how do you consider goodwill?
You want to go, Joe?
Well, anything differently? Well, again, knowing the different standards of value would be important for Connecticut. I know they have the moving valuation date versus New York, which might be more fixed. So that becomes a navigation part also with disclosures and this, Connecticut, everything's discoverable, so, making sure the communications are, always either fully disclosed but we know there's no personal goodwill in Connecticut. But versus New York is a goodwill state.
Yeah.
But that becomes just the intricate. Again, we lean on counsel to, help navigate those legal issues because we know we're accountants, not lawyers. But from our experience, we just try to make sure we're knowledgeable of the facts.
Yeah, and Connecticut's a state that we do a lot of work in, so we're really familiar with, what the different laws are. But if we get inquiries from, other states, we're gonna, like Joe said, we're gonna rely on counsel to kind of guide us in terms of what, we could do the valuation, but we need counsel to guide us in terms of what the laws are specific to that, jurisdiction.
And we have another question. Have you ever disengaged from the engagement based on the appearance of illegal activities, tax fraud, etc., based on the documents reviewed?
Repeat the question. Have we ever
Disengaged from the engagement?
disengaged? I don't know if we've ever disengaged. I mean, at the end of the day, like these types of issues are not, they're issues that we may identify. They're issues that will affect value. But, you know, I don't know that it's an area where we would necessarily disengage. I mean, obviously, if someone is not, if yeah, I don't know that I haven't seen a situation where we've disengaged because we've come across, you know, activity that, it- you know, is what we're really looking for. You know, that's really where the forensic analysis comes in. And so, you know, if we find those, you know, those types of expenses, you know, that's kind of what we're looking for. I can't think of a situation where we've disengaged.
We haven't disengaged, but like I said, going back to my example with when the guy gave us a second set of books and there was substantial amount of, unreported cash, we'll start now, you know, let's have a conference call with attorneys
Mm,
and everyone on record saying, okay, here's an issue that came up because I don't think you want your clients going in front of a judge who now have obligations to, if they hear this information, are they going to now, what steps are they going to do? Are they going to contact IRS, sales tax issues? So, when information like that does come up, it's very important for the valuation person to now make that, disclose that knowledge. Because you never want to get caught of saying, hey, you heard information, you ignored it, but why'd you ignore it? And or you considered it, and why'd you consider it without at least talking to us first? This is a big financial factor or criminal factor that we wanted to get in front of first before we you start putting it out there. So I think at least from our experience, if those issues do come up, we usually bring everybody on board on the same knowledge and say, here's what we're told, and how do you want us to proceed? You know, if it's a
yeah,
very sensitive issue.
that's a good point. Anything else, Sammy?
No, there are no more questions.
Okay, so if there's any other questions, you know, feel free to reach out to Joe or I, you know, at any point. So at the end of at the end, you're going to get a survey that's going to, you know, give us some feedback on topics that you're interested in for future webinars. So if you could please complete the survey. And also just please look for emails regarding the next webinar within this series, which is going to be, again, June 24th, and it's going to be discussing the income approach, valuation adjustments, and double dipping. And with that, we want to thank you for your attendance. And, you know, again, if you have any questions, please feel free to reach out.
Thank you.